My idea of value is that companies have a lot of cash. They're in the business of selling stuff at a very profitable margin. They're in a position to share that cash with you in a dividend.
Westwood Management's founder and director emerita is on Consuelo Mack Wealth Track.
Funding provided by ClearBridge Investments, the Fairholme Foundation, First Eagle Investments, Bill Miller, Baird, Strategas Asset Management, Research Affiliates, Royce Investment Partners, Seafarer Capital Partners, and Women Investing in Security and Education.
Hello and welcome to this edition of Wealth Track. I'm Consuelo Mack. Head spinning, vertigo inducing, shocking. Those are all adjectives used to describe the financial markets since President Donald Trump introduced his worldwide Liberation Day tariffs on April 2nd, 2025. Since then, he has changed them several times, sending the markets plummeting or soaring depending on the news. Wealth Track is a program about long-term investing. We choose our guests based on their experience and performance over many market cycles and focus on their advice learned over a lifetime of investing. Like a Frontliner 60 Minutes, we tape our interviews in advance. We interview 4 guests once a month. Usually it works out fine, but recently events have changed so rapidly that an afternoon discussion can be behind the news the next morning, let alone the next week. So what is the best way to handle this? Tell you the date we conducted the interview. We sat down with this week's guest on Friday, April 11th, the end of one of the most volatile weeks in Wall Street history. Our guest is Susan Byrne, Director Emerita of Westwood Holdings Group, the parent company of Westwood Management, which she founded in 1983. Among many other responsibilities, she was Chief Investment Officer and Portfolio Manager of a family of mutual funds. Smart Money magazine named her one of the world's greatest investors, along with a select group including Warren Buffett, for her outstanding performance. Byrne has managed portfolios through bull and bear markets, financial crises, pandemics, and now radical policy shifts. I asked her how this one stacks up.
I would say that this one stacks right up there. And as you said, I've been through quite a few of them. When I started our firm, which is Westwood Management, it was 1983. Right. I've been through a lot, and it reminds me more of when we had a crisis in Asia, because it involved very sophisticated markets around the world and very much into currencies. This week, the thing that has most investors, at least the people I speak with, are equity oriented. Everybody knew that the market had been wonderful and great and things were, certainly fully valued and all of that. That was known. But what we hadn't anticipated was the shifts in currency. We saw gold moving up, but one of the things we have to think about now is that the flight away from our dollar assets. And that is something that is very serious. The fact that people could be that they're losing confidence in holding dollars, seeing that we owe everybody in town. If they won't take our collateral, our good name, then interest rates could continue to rise as the economy is going down. And obviously that gap widening will be really bad. The fact that stocks are going down, they always do. And for investors like myself, is that you're investing for 5, 10, 20 years. And you'll go through, hopefully, no more than once every 5 years, but you could go through it depending on a currency problem. So I would say that's the thing that worries most people. And through a currency adjustment period, all of our assets get repriced. We get through it, but we don't know exactly whether our assets will be worth more or worth less. And when you're in that period of uncertainty, it gets scary.
And you're a value investor, so how are you navigating the uncertainty?
The uncertainty for me means that, and my idea of value is that companies have a lot of cash. They're in the business of selling stuff at a very profitable margin. They don't have a lot of debt to pay back. They're in a position to share that cash with you in a dividend, or to husband that cash for a rainy day for the shareholders in the form of buying back their own stock to make things less volatile for their shareholder. That's their job. I mean, they're in business to create profits to share with the shareholder. Now, I prefer dividends. Some people would rather have them buy back the stock. But either way, my idea of value is people that have the money, because the people who have the cash rule when you go through a time like this.
One of the things that you told me is that you do have a worst case kind of scenario type of analysis of companies, that who can survive the worst case scenario. Give us some examples of companies that you've decided can and have.
Yes. Well, there's one that everybody knows. I'd like to put it in this context because it doesn't pay a dividend, and that is Berkshire Hathaway. And people would go, oh my gosh, well, why would you own a company like that? I don't know how to value it. And I own it because it's a proven fact that the person that runs it is, I would say, much better than I am as a capital allocator. And so I may not know the future. I know that there is a group of people that will not buy expensively. They will sell when things are expensive, and they will husband cash and wait until the time to buy again. They right now have, over $100 a share in cash.
Right.
On their balance sheet now, in treasuries.
I also might add, Susan, that Smart Money Magazine at one point named you one of the world's greatest investors with a handful of other people, including Warren Buffett. So it is very appropriate that you should own Berkshire Hathaway stock.
Normally they don't make mistakes, but they certainly should not put me in his category. But must I say that I like dividends, so I've had to kind of hold my nose a little. And he says he prefers to buy back the stock when it gets down close to book value. I understand that's a very traditional value, kind of Graham and Dodd approach. And he thinks that he can do better with the cash than I could do if he gave me part of the money and a shareholder. And I agree with him. He has a long record. One of my all-time favorite long-term stocks is Apple, and it's been under pressure, a lot of pressure. He owned an enormous part of the company and sold it starting almost a year ago at much higher levels.
Right.
And that's part of his cash hoard now. So from my viewpoint, the way he runs that and the people that are working and have been trained with him they are demonstrably good. They own really good businesses. So his businesses may have a little bit more in common with businesses that I like. And I trust him. That particular company is what I would call a core holding.
Right. There are other companies as well that do pay dividends that you've owned over the years. So is there a core dividend paying company that, again, that you can say that kind of epitomizes the kind of companies you invest in?
Not very sexy name, and it has a little bit of hair on it, would be a Johnson & Johnson. Right. And Johnson & Johnson had difficulties with, talc, and it's had some problems, and they're not totally solved. They're a very, very profitable company, and they have raised their dividend every year for 62 years. Somebody who used to run a company, I find that amazing. That's real stewardship from my viewpoint.
A tradition, right, of stewardship.
Yes.
But you feel that the culture of J&J is still there.
The culture is definitely there. I think they will get this behind them, and I think that will not interrupt this spectacular record they have achieved in dividends and in the progression of them. Just reminding ourselves, Consuelo, The stock market and the long-term returns, which is what we're looking at as investors, we're not traders, is over half of it is made up of dividends.
Yes, the total return.
So in the weeks that we've had, you want to sort of drill that into your brain because it's hard to remember that when you're in the crucible of this kind of volatility we've been enjoying.
One of the things that you told me about, again, for 50 years, navigating, markets kind of through thick and thin, is that humility is your companion. Can you explain that philosophy?
I think when you're young, you might have humility somewhere running around in the room, and you're telling it to get away from you. You don't need it. You got an A in this class. Actually, humility is what comes from realizing that you don't know what's going to happen, that you're perfectly capable of making mistakes, and that this is a very difficult process. I think that if you realize that, you have to ask yourself when such and such is selling. Let's take an Apple, for instance. Let's say Apple is selling where it is. It's down, but let's just say it's there. And somebody says, I think enough has been done. And the first thing you have to realize, that may not be correct. And that is that the stock is selling where it's selling because it knows something. And what it knows right now is that the parts that it's making in China have just gone up 145%. Right now. It might change. They might go up higher. They might go lower. How are they going to get cash with this problem? So then you want to own companies that whose stewardship can do that. And you can say, well, what could they do? And it might be that you have no clue. You don't know how bad it could be. You don't know.
Right? You don't.
That's a reality, but a lot of people will think, well, it used to be here and now it's here, so surely this is a good price. Why? So what you want to know is, it's discounting something. What is it discounting? That China's going to cost a lot more. Okay. Do you know anything differently? And the answer, maybe 99 out of 100 times, is that you don't. So then you set up a paradigm where you say, well, what if in the next 2 years their costs go up X or Y? And you go through it, and you go through balance sheet, you look at the cash flow statements. After you've done the work, you say, is this a good price? And it may not be. The only difference is that the price is lower than it was. It doesn't necessarily mean it's a good price. So only good fundamental research and looking at worst cases can tell you, is the worst case that you can think of. I mean, obviously, we don't know everything that's going to happen in the future, but based on what you know, could it get worse? And in the case of Apple, sure it could. So then you have to say, is this the price? And I would have to say, for me, I don't know.
So right now, April 11th.
I don't know. What I do know is that I'm a shareholder of Apple. I've been a shareholder for time immemorial.
Barron's profile of you in 2001, Susan Byrne, you were recommending Apple at $18 a share. It was generating like $13 to $14 in
cash.
Cash, yeah. But so what's your analysis now? You own it. What are you going to do?
It's the same company. I can't know how and when China and the United States will work, because this is not a good thing for either one of them. So I don't know how long it will take them to come to something that would work. But when we get that information, we can look at it. But the real quick, why would I not sell Apple? I would not sell Apple because it's in a position to be a winner coming out the other end. You can't destroy the base of their customers. You could make it more expensive. They could choose to use some of their cash to keep the price down, but their ability to use technology and make it affordable and understandable for most people around the world is untouched. They're going to be able to do that, and they're going to be able to do it while they generate cash. So for me, our gains in Apple are way too high for me to sell it and try and buy it back. Because when you sell a stock, you're making two decisions, or you have to make two decisions, is that you have to sell it, and then you have to make a decision to buy it back. So when and how are you going to buy it back? At what price? And if it's at the right price, are you sure you'll have the nerve to buy it back? I'm not sure you will. So for those people that are holding appreciated stocks, ask yourself, are they in a position to come through a recession, to have countries, be silly and, in a schoolyard brawl about who's top of the mountain or whatever we're going through now, but eventually they'll figure out who gets to be on the top of the mountain and who's going to be able to stand up there. Walmart, they do pay a dividend. They have an entire history of running that kind of a balance sheet with much less margins, but the kind of volume that makes them very profitable. They've earned the trust of shareholders. So those are they're very different kinds of companies. I mean, Berkshire Hathaway is like a closed-end fund. And you get this guy to run it for you. I mean, it's amazing.
You always ask our guests on Wealth Track for one investment for a long-term diversified portfolio. And a couple of days ago, at least, you told me that it would be Apple. Is that still the case? And I'm talking about, this is for someone, not you, who's holding it necessarily, but somebody who would be a new position for them. Let's say your grandson or your grandchildren. I mean, would you advise that they buy Apple now for a long-term diversified portfolio?
At the point of which everything you hear and read is about Apple, they're just not going to make it. That's not true. They will make it. They have a dividend. It's not huge, but they've raised it every year for the last at least 5 years. Mm-hmm. And they generate tons of cash. They have tons of cash on their balance sheet. They will make it through. And what does it look like on the other side? It may be that they are the ones that have demonstrated a way to take very high tech to consumers. And I think they will win the AI, because the winner of AI, artificial intelligence, is the one that figures out how normal people could use it. Not how, people at MIT could use it.
Right.
I mean, that's interesting, but that's not a business. It's who can figure out that they will be comfortable asking questions with it. How will they use it? What instrument would they use? Who would they call for help? What store do they go to? That's Apple. In a recession, in a hard recession, in a difficult time, I think they're well prepared financially to survive and be there in a strong position coming out in the future. So that's why I would have them as a core holding. My personal opinion, not anybody else's, is that there's a lot of damage being done psychologically, because I can see it in the currency markets and the fixed income markets. Those are very important markets to see how people are feeling about how things around the world are going. So I think that the possibility of a recession in our mind, which we thought, might be 0 to 25%, 2 months ago, and with another week or so of this on and off policy, it may go above 50%. And so that says to me, I want to look at my exposure to some of the banks, regional banks. I want to look at some of my exposure to energy, some of my exposure to areas that would seemingly be okay because of tariffs. They're not necessarily affected by them. And some may think, well, those are good places to hide. But if we have a recession, they're not. We have a lot of real estate on balance sheets on regional banks.
Regional banks.
But should, because of these policy problems, we get into a crisis where all of a sudden a lot of banks' loans go to non-performing, that's not going to be very good. So that's the kind of scrubbing we're doing. And we're looking at all of our companies. Now, if you have companies that don't have a lot of debt, have good free cash flow, you're going to be less hurt. But in a recession, everybody gets hurt. And now, if that's true, why wouldn't I just put everything in cash? Because with humility as my companion, which we talked about before, I don't have confidence that when it was time to put the cash back in the market, I would do it. Usually that's where you're most frightened.
Right.
And then the market rallies and you're safe.
But you missed out.
But you missed it.
Right.
And you're in cash. So you've got your money, but you've missed the important part of long-term investing.
Susan, a lot of investors are very concerned about what's going on in the markets and the uncertainty. The cash levels are, I think, at record highs in money market funds. You had a personal experience with one of your grandchildren and an adult who called you and was very nervous and says, "What should I do?" Will you share the advice that you gave to him?
First of all, I was, of course, as a grandmother, I was, thrilled that I got a call. But secondarily, I told him what I would tell a lot of young people, which is that you're investing for 20, 30, 40, 50 years. During that time period, before you retire, there will be a lot of these kinds of things that happen. They just happen because people are people and we do stuff like this. What I said to my grandson was, if you can't sleep, if you're upset and this is making you crazy, in the morning, sell those stocks out of your 401k. Just
the
sell
ones
them.
that are making you really nervous.
The ones. He had two that he said, I don't know what to do with. And I just said, listen, you're young. You have time. Sell it. Nothing is more important than who you are, your mental health. You have to be together at your job. So just sell them. Or if you find that it's just irritating you, then don't look.
Good advice, and very unusual advice from an investment professional. One of the things that you do is you listen to what the market is telling you. Talk about being humble, but what is the market telling you? What is the market telling you right now?
The market's telling me right now that it cannot discern a reasonable settings of what the outcomes are. First of all, nobody really understands what the goal is. If we were to assume that the goal is to have a policy in the United States to pay down our debt, okay, we can understand that. But is that the policy? We don't know. We don't know what's happening with the currency. The market's telling you it doesn't know how to assess the risks. Nobody knows what's going to happen in the future. But you have to have something to hold on to so you can have the illusion, at least, that you're doing the right thing. You have no illusions because all there is disillusionment. Then you're left very confused and you see this kind of volatility in the market.
Susan Byrne, thank you so much for joining us on Wealth Track many, many years later. It's just great to see you again.
Thank you. I had a great time. Thank you.
At the close of every Wealth Track, we try to give you one suggestion to help you build and protect your wealth over the long term. This week's action point follows the advice of Susan Byrne to a nervous relative who was losing sleep over his portfolio's volatility. It is get rid of your biggest portfolio worries. Review your portfolio, identify what is causing you the most anxiety, and sell it or them. As recent Wealth Track guest Robert Kessler told us, these are only stocks. and you can always buy them back. Now, I will admit that this advice is contrary to just about everything we've ever said about long-term investing and the dangers of market timing, and Peter Bernstein's famous adage that you are not truly diversified unless you own something that makes you uncomfortable. However, it is your life, and you should be able to enjoy it. So either don't look at your portfolio during stressful times or adjust it to suit your risk tolerance. Next week, legendary investor Jeremy Grantham is known for his prescient market calls. What is he saying now? Don't forget to follow us on Facebook, X, and our YouTube channel. Thank you for spending your precious time with us. Have a lovely Mother's Day weekend and make the week ahead a healthy, profitable, and productive one.